Hi, and today's short video is all about trading expectations. We all have them and they originate from various sources. The bottom line is they can be divided into two types. So expectations may be mathematical, which is a real expected value figure or outcome based on evidence. And secondly, they can be what's called epistemic, which are belief-centered and are based in the future. So in other words, what we would expect to get from our trading going forward. The problem is, in many cases, the expectations traders have between their reality and their beliefs about what they are going to achieve going forward is often very different. And this is what we can call the expectation gap. So if we look at our expected value, it should be based on your mathematical reality. As soon as it's not, then it is epistemic. And these are what you are actually doing now, your results as you see them in whichever way you choose to record them. So examples of this may be an overall profit loss on individual trades, win-loss ratios and average win versus average loss. This should be your expected value and based on a number of measurements over a period of time, not last week or last month, but over a series of weeks or months. At a more advanced level, we can start to measure the probability of events occurring in certain market conditions and with different strategies that we can use. Then again, we can assign real evidence-based values that can facilitate dollar projections going forward. Additionally, of course, if these are below what we would expect, we can use this as motivation for measuring the why behind our results and put some things in place to try and raise those real expectations based on mathematical evidence. Epistemic expectations, as we've already stated, are based in the future. Part of the problem is we often vicariously take on the performance of others as our expectations. If we see other traders trading on trading rooms, in seminars, and listen to their results, then they automatically become our expectations. Additionally, we may also have a particularly good or bad short trading period, so a good month or a good week, and this may also alter our expectations of the future. These are not your reality if over a short trading period, or if heard from someone else, and may be unreasonable. If we have an expectation gap, this can lead us to trade differently. So it may result in us taking on additional risk. We're not meeting an unreasonable expectation, altering our perception as to our worth as a trader and perhaps withdraw completely. It may result in us skipping systems or strategies which would work perfectly well for us. It is often short term and worst of all can alter spending. So we make financial decisions based on a future expectation, not on our reality. This is the place where most traders make most decisions most of the time. But there is some good news too. Epistemic expectations can be the motivation if we recognize that there is a gap to do something about it. So in terms of actions you can take, first of all, the bottom line is you should measure trading results now. From that, you can deduce what's real for you in your trading and know that if you continue to do what you're doing, this is what you can reasonably expect going forward. If there is an expectation gap, you need to measure the why behind your results. Is it your trading system? Are you following your trading system as you should? They will be the two key start points to try and get to the basis of what's happening. The reality is, of course, that in 80-90% of cases, it's a person not following a system rather than a system not working. Measurement is the only way to start to change things. Now, just as a finishing thought, we are looking at developing a new measuring trading course, so if you are interested, then drop us a line at mike@hawkeyeoptions.com and we'll gladly send you some information through so you can make a judgment on how measuring trading can contribute positively going forward. We'll see you again soon.